as someone who spent 10 years on Wall Street, these are kind of the questions I had. I'm going to try to pull stuff out of you to help the average person. I think a lot of people the last 2 years got heavily entrenched in, I'll call it tech, right? For lack of a better term, whether it's big tech or money losing tech, whatever it is, tech,
or
tech,
communication
tech.
services, which is Facebook. Yeah. We'll call that tech as well. Yeah.
Yeah. What advertising, whatever you want to call that. Right.
Right.
I think what we're going to see, at least over the next year and possibly two, is value. Dividend growers are where people should consider. And I don't think the average investor knows how to look at value. Everybody wants growth. Everybody's buying, people at 100 times revenue, or it's not even profit, it's revenue. And so let's just talk about value, because I think that's something that, if you have, nobody's looked at in a long time.
Yeah, I think it's important to realize right in the onset the difference between what a growth and a value stock is. Realistically, a lot of people hear growth, they're like, of course I want the companies that are going to grow.
Yeah, of course. Right? Why
not? Growth, that sounds great.
What are you talking about, Zuber?
Right, exactly. And the line of what the demarcation between growth and value moves over time. But essentially, growth companies are those that are more expensive on a valuation standpoint. And they're more expensive most of the time because they have a faster growth rate. So it is growing faster, but you're paying up for that future expectation that the growth continues to move in a faster direction. Whereas value stocks on the other side, think about them as things that might be on sale from a value perspective, but they might be on sale because the growth rate of the company just isn't there. Think about a Johnson & Johnson. That's a historic value
Clorox
company.
Or
yeah, exactly. They're selling boring stuff. The business is not going to explode overnight. There's no logic behind why that would happen, and therefore they have a cheaper valuation. Mm-hmm. And so what you see is that if you look back, the last rolling recession that we've had was the 99, started real late 99, 2000, 2001, 2002. It was a 3-year long period of time of just the market slogged downward, sideways, chopped before it bottomed and came out of the other side. If you look at tech, that was the hot dot, the dot-com bubble that was put together there. And that tech space, if you had taken it, and I talked about this a week ago as well, if you take that tech space, a 1-year period after the downside started, after 1 year, which is where we're at now, 5 years forward from there, they were still cumulatively negative for a 5-year period of time. And the reason I say that is just to think that people say, okay, growth got absolutely smoked, but it's going to bottom. It's got great value right now. We're going to see explode out of the other end.
How many times have I heard, I'm going to buy the company, it's off 70%. That's not a reason to buy a stock.
Yeah, no kidding. And you know what? Historically, if you look at companies, and you would rather purchase them at a 52-week high than you would at a 52-week low. I mean, it sounds counterintuitive because you want to buy high and sell low, but historically, again, I'll repeat this, you've been better off purchasing companies that are at a 52-week high than they are at a 52-week low.
And momentum.
That momentum. Exactly.
Either way, up or down. Yeah.
Correct. And so you have to be aware of that. And what has momentum right now versus the corollary is value stocks have momentum, dividend-oriented stocks have momentum. Boring stuff that creates consistent, reoccurring revenue and cash flow is what's being rewarded in the market right now.